In 2019, 42% of homes sold in America were priced under $340,000. Starter homes, first-time buyer homes, the entry point to building wealth through real estate. In 2024, that number dropped to 17%. In 2025, it hit 12%, and in the first quarter of 2026, it's now sitting at 8%. Homes under $340,000 are vanishing from the market, not slowly, rapidly. Two buyers, same age, same income, same down payment saved. One bought in 2019 at $310,000. One is trying to buy today and can't find anything under $420,000 in the same city. The difference isn't effort, it's timing, and the wealth gap this creates is permanent. Most people assume this is just a market cycle. Prices go up, prices go down. Eventually it corrects. That assumption is wrong, and understanding why it's wrong determines whether you build wealth in the next decade or watch from the sidelines. This isn't just about homeownership. This is about the primary wealth building mechanism that created the American middle class for 70 years. When starter homes disappear, the entire wealth ladder breaks, and most people don't realize it's already happening. I'm Kevin. This is Prosperity Levels. Today, I'm breaking down why homes under $340,000 are vanishing, what's causing it, why it's not reversing, and what it means for your wealth strategy, whether you own a home or not. The data behind the disappearance, the 3 structural forces making it permanent, the 5 strategies that still work, and the uncomfortable truth about who this benefits and who it destroys. By the end, you'll know exactly how to navigate this shift instead of becoming a casualty of it. Why exactly $340,000? Why is that the number that matters? Because according to Redfin and Zillow data, $340,000 represents the maximum purchase price for a median income household to afford a home with 20% down and stay under the 30% housing cost rule. It's the mathematical ceiling for normal people to enter homeownership without becoming house poor. And that ceiling is disappearing. Let me show you exactly what's happening. In 2019, there were 2.1 million homes listed for sale under $340,000 in the United States. That represented 42% of all available inventory. In 2024, there were 780,000 homes listed under $340,000, 17% of inventory. In the first quarter of 2026, there are approximately 340,000 homes under that threshold, 8% of what's available. That's an 84% decline in affordable starter home inventory in 7 years. Not a correction, a structural collapse. For context, during the 2008 housing crash, inventory dropped 31% peak to trough. This is nearly 3 times worse. This isn't just coastal cities. This is everywhere. Boise, Idaho, median home price in 2019 was $298,000. Today, it's $512,000. Austin, Texas, $340,000 in 2019. Today, $565,000. Phoenix, Arizona, $285,000 in 2019. Today, $448,000. Even secondary markets that people fled to are now unaffordable. Median household income in 2019, $68,700. In 2026, $81,200. That's an 18% increase over 7 years. Median home price in 2019, $285,000. In 2026, $412,000. That's a 45% increase. Income went up 18%. Home prices went up 45%. The gap is mathematically widening. At 6.8% mortgage rates in early 2026, a $340,000 home with 20% down requires a household income of approximately $95,000 to stay under 30% of gross income for housing costs. Median household income is $81,200. The median household can no longer afford the median home. That hasn't been true since the 1980s. Only the top 35% of earners can comfortably afford a $340,000 home under current conditions. In 2019, 60% of households could afford it. We just locked 25% of the population out of homeownership in 7 years. Those are the numbers. Now, let me show you why this is happening and why it's not reversing. Homebuilders are not building starter homes anymore. And it's not because they don't want to. It's because the math doesn't work. Let me show you why. The cost to build a home, land, materials, labor, permits has increased 62% since 2019, according to the National Association of Home Builders. Profit margins on a $340,000 home are now 3 to 7%. On a $550,000 home, they're 12 to 18%. Builders have finite capital. They're allocating it to higher margin products. Developable land near employment centers is finite. Zoning restrictions have increased. Environmental regulations have increased. Impact fees have increased. In many metros, land costs alone represent 40 to 50% of the final home price. When land costs $100,000, you can't build and sell profitably at $340,000. The math forces you upmarket. Skilled construction labor has been declining for 15 years. The average age of a construction worker is 53. When labor is scarce, builders allocate it to higher profit projects. A crew building a $550,000 home generates more profit per hour than the same crew building a $340,000 home. This is a rational economic decision, and it's removing starter homes from future supply. In 2019, 31% of new construction homes were priced under $340,000. In 2024, 9%. In 2025, 4%. Builders are not solving this problem. They're actively moving away from it. The second force: people who own affordable homes can't afford to sell them. This sounds counterintuitive. Let me explain. 62% of homeowners with mortgages have interest rates below 4%. 38% have rates below 3.5%. Current mortgage rates are 6.8%. If you bought a $300,000 home in 2020 at 2.9, your principal and interest payment is $1,245 per month. If you sell that home today for $420,000 and buy another $420,000 home at 6.8, your new payment is $2,740 per month. You just increased your housing cost by $1,495 per month, $1,800 per year to move laterally. Economically rational homeowners are staying put. They're renovating instead of moving. They're tolerating longer commutes. They're staying in homes that no longer fit their needs, because moving costs them $10,000 per year in additional mortgage payments. This creates a supply freeze. Starter homes that would normally turn over every 7 to 9 years are now being held for 12 to 15 years or longer. Those homes aren't hitting the market. First-time buyers can't access them. Housing turnover rate in 2019, 5.8% annually. Housing turnover rate in 2025, 2.9% annually. Half as many existing homes are being listed. The locked-in effect is real and measurable. The third force: institutional and small investors bought aggressively between 2020 and 2023, removing hundreds of thousands of starter homes from owner-occupied supply. According to Redfin, investor purchases peaked at 32% of all home sales in Q4 2021. Investors disproportionately target homes under $400,000. Why? Better rental yields, lower acquisition costs, easier to scale. Those homes didn't come back on the market. They're now rental properties. Approximately 780,000 single-family homes that were owner-occupied in 2019 are now investor-owned rentals. That's 780,000 fewer starter homes available to first-time buyers. Permanently. Invitation Homes, American Homes for Rent, Progress Residential institutional landlords now own over 600,000 single-family homes. Their average hold period is 15 to 20 years. They're not selling. They're refinancing and holding for cash flow and appreciation. Small investors, people who own 1 to 10 rental properties, own an additional 8 million single-family rentals. Many bought at 3% mortgage rates and are cash flowing $400 to $800 per month per property. They're not selling either. Why would they? This is permanent supply removal from the for sale market. These homes have been converted to rentals and are not coming back. First-time buyers are competing for a shrinking pool while investor-owned inventory sits off-market generating income. Let me bring this together. Force 1. Builders aren't building affordable homes anymore. Force 2. Existing homeowners can't afford to sell. Force 3. Investors bought and converted hundreds of thousands to rentals. These three forces are structural, not cyclical. They don't reverse with a rate cut or a policy change. Now that you understand why it's happening, let me show you what it means for your wealth strategy. The first implication: we're creating a permanent renter class in America. Historically, 65 to 68% of Americans own homes. That was the equilibrium for 50 years. We're now at 62% and dropping. Renting is not inherently bad, but renting prevents the primary wealth building mechanism most middle-class families used for generations: forced savings through mortgage principal paydown and home appreciation. A homeowner paying a $1,800 mortgage is building equity. A renter paying $1,800 is building their landlord's equity. Over 30 years, that's the difference between $400,000 in home equity and zero. According to the Federal Reserve, the median net worth of homeowners is $255,000. The median net worth of renters is $6,300. That 40-to-1 gap is driven primarily by home equity. When homeownership becomes inaccessible, that gap widens permanently. The second implication: family wealth and inheritance become the primary determinant of homeownership. First-time homebuyers in 2026 receive an average of $48,000 in down payment assistance from family. 10 years ago, that number was $18,000. If your parents own a home with equity, they can gift or loan you down payment funds. You can buy. If your parents don't own a home, you're saving $80,000 to $100,000 for a down payment on your own while paying rent. That takes 8 to 12 years for median earners. One group buys at 28, the other buys at 38. 10 years of appreciation and equity building lost. This creates a self-reinforcing cycle. Homeowners pass wealth to their children, who become homeowners who pass wealth to their children. Renters can't pass home equity because they don't have it. Their children start from zero. Wealth stratification accelerates. The third implication: geographic mobility. The ability to move for better opportunities dies for homeowners and renters alike. Homeowners are locked in by mortgage rates. Renters are priced out of moving to higher opportunity cities where rents are even higher. If you're a software engineer in Cleveland earning $95,000, and you could earn $140,000 in Austin, but rent in Austin is $2,400 versus $1,200 in Cleveland, the move doesn't pencil. You're stuck, not because you lack skills, because housing costs consume the wage premium. Labor mobility drives productivity growth. When people can't move to where their skills are most valuable, the entire economy grows slower. This isn't just a housing problem, it's a productivity problem. The fourth implication: rent becomes the largest wealth transfer from the middle class to investors in American history. Total rent paid annually in the U.S. in 2026, approximately $580 billion. Of that, roughly $190 billion goes to investor-owned single-family and small multifamily properties. That's $190 billion per year in wealth transfer from renters to property owners. Total rent paid annually in the U.S. in 2026, approximately $580 billion. Of that, roughly $190 billion goes to investor-owned single-family and small multifamily properties. That's $190 billion per year in wealth transfer from renters to property owners. Those are the implications if you do nothing. Now, let me show you the 5 strategies that still work. The first strategy: move to where affordable homes still exist. Not every market is equally broken. Some metros still have inventory under $340,000. According to Realtor.com data, These metros still have meaningful inventory under $340,000. Huntsville, Alabama, median $312,000. Des Moines, Iowa, median $298,000. Oklahoma City, Oklahoma, median $285,000. Wichita, Kansas, median $267,000. The trade-off: these are not high-wage markets, but if you can work remotely or have transferable skills, you can buy a home at 28 instead of waiting until 38 in Austin. 10 years of equity building versus 10 years of renting. The wealth gap that creates is 6 figures. The second strategy: house hacking. Buy a duplex, triplex, or fourplex, live in one unit, rent the others. This is how people are still accessing homeownership in expensive markets. A fourplex in a tertiary market might cost $480,000. You put 20% down using and loan lower down payment on owner-occupied multifamily. 3 units rent for $1,200 each. That's $3,600 monthly income, covering most or all of your mortgage. You're living nearly rent-free while building equity. The catch: you're a landlord, you're managing tenants, you're doing maintenance, but the wealth-building trade-off is worth it for people willing to exchange time and effort for equity. The third strategy: accept that homeownership is delayed and invest aggressively in index funds and alternatives instead. If you're paying $1,800 in rent and saving $2,000 per month into investments, earning 9% annually, you'll have $270,000 in 10 years. A homeowner with a $1,800 mortgage on a $340,000 home appreciating at 4% annually has $195,000 in equity after 10 years. The renter who invested comes out ahead by $75,000. The asterisk: this only works if you actually invest the difference. Most renters spend it. But if you have the discipline, renting and investing can outperform homeownership in high-cost markets. The fourth strategy: co-buy with family or friends. This is becoming normalized. According to a 2025 survey, 18% of first-time buyers co-purchased with non-spouse partners. 2 couples buy a duplex together. Each lives in one unit, both names on the mortgage. Legal partnership agreement outlining exit terms. You just cut your down payment requirement in half and your mortgage payment in half. The risk: relationships change, jobs change, people want to move. But with a well-drafted operating agreement, this can work for 3 to 5 years while both parties build equity, then sell, or one buys the other out. The fifth strategy: stop tying wealth building to homeownership entirely. Build wealth through business ownership, stock portfolios, and alternative investments. Buy a home later when you have serious capital. Homeownership was the wealth-building vehicle for the middle class because it was accessible and forced savings. It's no longer accessible for many. That doesn't mean you can't build wealth. It means the vehicle changed. Focus on building $250,000 to $500,000 in investable assets. Then buy a home with cash or a massive down payment. You skip the mortgage entirely. You skip the interest. You buy from a position of strength. This takes longer, 15 to 20 years instead of 7 to 10, but it's viable, and in some cases, it results in more wealth than the traditional mortgage path. Those are 5 strategies that work. But let me give you the uncomfortable truth nobody wants to say. Who benefits from starter homes vanishing? Existing homeowners. Their home values go up because supply is constrained and demand is steady. Investors. Rental demand increases, so they can charge more and their properties appreciate faster. Builders. They earn higher margins on expensive homes than cheap ones. Who loses? First-time buyers locked out of ownership. Renters paying increasing rents with no equity. The next generation unable to access the wealth-building mechanism their parents used. Existing homeowners vote at much higher rates than renters. 68% turnout versus 41%. Politicians respond to voters. Homeowners don't want policies that lower their home values. So politically, there's no incentive to fix this. The beneficiaries have the votes. Zoning reform could help. Reducing regulatory costs could help. Incentivizing starter home construction could help. None of these are happening at scale because the people harmed by the current system vote less than the people benefiting from it. This is not reversing. Rates could drop to 4%. It won't bring back starter homes because the structural forces remain. Builders still won't build them. Locked-in homeowners still won't sell. Investors still won't convert rentals back to for sale. You have two choices. Wait and hope the system fixes itself, or adapt your strategy to the system that actually exists. Homes under $340,000 are vanishing, not cyclically, structurally. Builders aren't building them. Homeowners can't sell them. Investors converted them to rentals. This creates a permanent renter class, makes inheritance determinative, kills geographic mobility, and transfers wealth from renters to owners at unprecedented scale. 5 strategies still work: geographic arbitrage, house hacking, delay and invest, partner buying, and build wealth elsewhere, then buy later. None are perfect. All require trade-offs. The uncomfortable truth: this benefits existing owners and harms future buyers. And politically, there's no fix coming. Where does that leave you? If you're under 30 and don't own a home, you need to decide: move to affordability, house hack, invest instead, partner buy, or delay until you have serious capital. If you already own a home, congratulations. Your largest asset is appreciating because supply is constrained. But understand, your kids might not have the same opportunity unless you help them. Calculate what you can actually afford at current rates, not what Zillow says. What you can afford and stay under 30% of gross income. If that number is below $340,000, you're priced out of most markets. Choose one of the 5 strategies. If you're waiting for rates to drop or prices to crash, set a deadline. If neither happens in 2 years, pick a strategy and execute. Waiting indefinitely is a strategy that guarantees losing. Drop a comment. Do you own a home? Are you trying to buy? Or have you decided renting and investing is the better path? I'm curious where this community is on this issue. Next video, I analyzed 500 broke 6-figure earners and found the exact spending pattern keeping them stuck. Number 2 shows up in 83% of them. Subscribe and turn on notifications. Homes under $340,000 are vanishing. The wealth ladder is breaking. You can't control the system, but you can control your response to it. Homes under $340,000 are vanishing. The wealth ladder is breaking. You can't control the system, but you can control your response to it. I'm Kevin. This is Prosperity Levels. We document how the system actually works, not how we wish it worked. The data is real. The forces are real. Your strategy needs to match reality. Go build. Important disclaimer: not a financial advisor or real estate professional. This content is for educational and informational purposes only. Real estate markets vary significantly by location. Always do your own research and consult licensed professionals before making housing or investment decisions.